We're halfway through 2025, and this has already been a dramatic year for markets. It may be one we look back on as a watershed for investors and global order more broadly. Some long-standing investment rules have come under serious question under the strain of tariffs, war, and political unrest across the world. One of those rules is the role of the US as a supposed safe haven to shore up portfolios. President Trump has actively targeted the dollar as he seeks to reduce the twin deficits that he believes have undermined American growth. The question now is whether the move away from US assets represents a short-term response to today's changing environment or something more structural. What's clear is that we are witnessing some kind of global fragmentation. That means diversification will be more important than ever. Our analysts report very differentiated exposures to economic factors across regions and sectors. Happily, today's panel is on hand to explore where the effects may be felt most keenly. I'm joined by Niamh Brodie-Machora, CIO Equities, Max Stainton, Senior Global Macro Strategist, Henk-Jan Rickerink, Global Head of Multi-Asset, Real Estate and Systematic, and dialing in from Hong Kong is Lei Zhu, Head of Asian Fixed Income. Thank you all for joining us today. Before we start, just a reminder that you can use the Q&A function to ask any questions you may have throughout the discussion, and we'll try to answer some of those in the next 45 minutes. That's it for the housekeeping. Now let's kick it off with a macro backdrop. Max, over to you.
Thanks, Austin. So if we kind of focus on the US first, we find three main things have happened since our Q2 outlook update. Firstly, Liberation Day tariffs were kicked in, at kind of skyrocketing that tariff rate to kind of since pre-World War I highs. Then we had the US-China détente, which brought those tariff rates down to more sustainable levels. And then thirdly, we're seeing the US really struggle to come to meaningful deals with kind of countries around the world. We expect inflation to rise back up to 3%, likely hitting 3.5% over the course of this year and staying there over the first half of next year. And then similarly for growth, a downside shock, taking growth sub 1% for the rest of this year, as the economy has to kind of rejig and relearn what this new kind of supply chain mix looks like. So that's the baseline outlook. If we then kind of turn to kind of how we see the tails on either side, our main high conviction point is inflation to be higher for longer. So we have reflation at 40% and stagflation at 40%, and we've now moved our recession odds down to 20%. And that really kind of, for us as a signal is inflation is here to stay, and that's a high conviction view. But ultimately, we still see small downside growth risks relative to where growth expectations are now. But of course, growth expectations have come down significantly over the last 2 months as a reaction to all these policy changes. So that's for the US. If we then kind of turn to the rest of the world, really what we find is, especially for Europe and China, but globally as well, the world is having to react to these new American policies of trade war. And so for Europe, we find the growth outlook for the second half of this year is likely to be weak as a result of a trade shock coming from a difficulty in coming to a conclusion that is satisfactory to both parties. But actually for China, because they've been able to stimulate and been able to react and kind of have already planned out what to do, we're seeing actually growth is stabilizing. And so both economies having to react to this kind of global trade shock, but so far navigating it differently, as Europe struggles to kind of get a coherent stimulus together, whereas China is already ready to go. And then finally, if we just turn to what this means for assets, as you already mentioned, one key takeaway for us is the dollar is likely to be on a kind of meaningful downward depreciation cycle over in a structural basis over 5 years or more, and kind of really for two reasons. A, the US has effectively imposed on itself in terms of trade shock, and B, given valuations are already at very extreme levels, and the interaction of those things is likely to set off a kind of multi-year dollar down cycle, which, as you can see from the slide, you typically see median returns when you are at these valuation levels of kind of minus 20%. So that's how we're seeing the global macro outlook today.
Perfect. Thank you very much, Max. And I think that's, looking at the US, this first question is a very good one for Niamh to basically comment on that, because obviously there's a lot of uncertainty out there. A lot of risk factors have come up in the first half of the year, but yet the S&P 500 is back to an all-time high. And, it's probably based on optimism about trade deals being done right now and the big, beautiful bill that could put, a fiscal push to the US once again. Is this optimism for the US justified, and how can it be really backed up economically?
Thanks, Carsten. Yes, you're exactly right. The US market is now up about 5% year to date. So it staged a really remarkable recovery from the April lows. So remember, we were at, skirting with full bear market, 20% correction less than 90 days ago. So really, really quite a remarkable recovery. The phrasing of your question is really interesting, Carsten, because we need to remember the stock market can actually be a predictor of economic indicators as well as being a product itself of them. So I think let's break that down in terms of what we have actually seen on the economic side, what we can think about in terms of the outlook, working further on Max's scenario and an outlook that he's shared, and then figure out, right, is this optimism justified? So let's think about first valuation. Right? On the valuation side, we are in an era of structurally higher uncertainty, and that should impact on the risk premium. But we're not seeing that in stocks at the moment. So I think that's point number one. Let's put a pin in that one and perhaps come back to it at a later point. Then let's go to earnings and think about the economic factors that can matter for earnings. So firstly, tariffs. Yes, we are better than we could have been based on what was indicated on Liberation Day. But it's still a factor, and it's still a material factor, and that will impact on costs, it will impact on prices, it will impact on supply chains, all of them in very different ways, but potentially in very negative ways. And as Max has indicated, we think there is a probability of stagflation that is now higher in coming quarters. So that's one area. The second is the big, beautiful bill, which the Senate passed just yesterday. The market is reading this as a positive for growth, and indeed it's hard to argue against that because it will give a fiscal impulse to the economy. So the market is focusing and indexing on that. It does also raise the risk for the longer term because you're going to see US debt continue to increase at a good clip. But at the moment, the market is focusing much more on the former. And then let's talk about everything else. If we say the third bucket is everything else, so what's actually happened in the economic data year to date? So the jobs market has looked okay. The consumer market has looked, again, okay. Sentiment is still down, though. But the first quarter GDP print was actually a negative. It was actually down, and ironically, it was because of the trade deficit actually deteriorating in the US, which was quite surprising. So if you put all of those things together, it's hard to see why we should be up year to date. So it seems like you do need to take a lot on faith to actually have confidence that we've got a really robust risk reward going forward. As you know, Carsten, and as I expect all of our clients know, we don't in Fidelity want to take things on faith. We want to understand the data. We want to figure out what the risk reward looks like from here. So that's why we rely on our crack macro team. We also rely on our analyst team. So hot off the press, we have our most recent monthly analyst survey. We ask them, what is your base case economic forecast that you're using? Because again, we have within a team of experts the wisdom of crowds. And they have increased the probability of slowdown. The number of analysts that are using a slowdown and a serious slowdown within their forecasts has gone up. And importantly, management sentiment is still negative. It's off the lows, but it's still negative. So from our perspective, it is a lot baked in terms of ongoing positive activity that could indeed come through, but it means you need to incorporate that in your risk reward.
And that's what I want to come back on the valuation point that you made earlier. The US has regained all of its valuation premium that it had before, and we all argued the US is expensive, and it has been expensive. But what is it based on? Now, looking at earnings growth, let's say for next year and the Magnificent Seven, is it justified? Can the earnings growth path be even higher from here? What are earnings expectations for next year, and how does that compare to other regions?
Carson, yeah, let's get specific for a moment. So the US market is on 23 times current year earnings, 21 times next year's earnings. So when we've spoken in previous webinars, I've shared the view that there are reasons for the US re-rating over the past decade. Amazing quality companies, great profitability, great returns, great balance sheets, but also the expectation of higher growth in the future. So that is a really, really critical point. So let's think about what's actually happened year to date in 2025. Q1 came in quite well in terms of corporate earnings. You know, more companies beat than miss. But you could say quietly, or you could say not necessarily top headline across the market, both the sell side and investors have been reducing their earnings expectations for 25, for 26 and beyond. So that is a really, really important dynamic. When we think about the ability of the market to grind higher from here, that earnings trajectory has to flip. Because if it doesn't, there's a certain point where the market starts to say, why are we paying 23 times earnings for a market that is not generating structurally higher growth than other opportunities elsewhere? So what could do that? Two things. You could have economic Goldilocks. So you could have a situation where, yes, you get this policy stimulus that helps the economy. You don't get runaway inflation. So therefore, the Fed can cut quite quickly and you get a broad-based recovery in earnings. It's possible, but as we shared already, it's hard to have conviction that you really have all of the different component parts to say, yes, this is giving me a great risk reward. You could have a narrow-based improvement in earnings driven by the tech sector leaders. Again, we can come back to that, Carson, at a later point. It's not impossible because certainly the sentiment from the tech sector in the US remains extremely bullish, but we think there is a lot of controversy there, and we think it's hard to say that every single part of that part of the market is going to really deliver, really beat earnings expectations. So again, we come back to the argument for diversification on other regions. Earnings growth has been broader in Europe and in EM. The valuation starting points are much more attractive. So we actually think there is real reason to be diversified outside the US at this point.
Now that you mentioned the Fed, I want to quickly come back to Max and ask about the Fed outlook, because the market is pricing in, I think, 2 more rate cuts this year. There's a discussion about the Fed chair successor, which might be announced early, so having a shadow Fed chief or so, because the president likes to have lower rates. So what do we make of that? Is that a reason for less trust to the US going forward? And what do we think of the Fed policy going forward, when you said inflation might reach 3.5% at the end of the year?
Yeah, absolutely. So I think with Fed policy, precisely to your point, we think inflation is going to be binding. So inflation above 3, with inflation expectations also rising, and given we've kind of seen a secondary supply shock from the immigration crackdown, actually potentially an unemployment rate that doesn't rise as fast as you would normally expect, and kind of this kind of shock really puts the Fed in a real bind, and will force them to kind of prioritize inflation, kind of fighting inflation and controlling inflation expectations, then coming to the rescue of the economy and payrolls. And so as a result, we're not expecting any cuts until basically the very end of the year, December, to your point, contrary to market expectations. And then just on the, obviously all this various chatter on kind of shadow Fed chair, the effect of this is probably going to be twofold, right? I think we now have kind of very high certainty that the next Fed chair will be cutting a lot. And so, the likelihood in kind of very kind of specific markets, you see kind of kinked curves where kind of as when the new Fed chair comes in, probably markets will start pricing a lot more cuts after that point. But more broadly, and this is probably more relevant for kind of global asset allocators, this is another reason to add a risk premium to US assets. And this is what we're really seeing. If we look at kind of term premium in the US, bond risk premium, that has risen significantly, in part because market uncertainty as to how Fed policy will react going forwards. As you bring that reaction function into question, then everything else can start spiraling and get re-rating higher because as discount rates kind of move up.
You mentioned asset allocators, and there I want to zoom out a little bit more and go to you, Henk Jan. We have a more volatile and uncertain economic environment right now, and we've heard from Max there's a lot of things that we need to scratch our head about. But so what would you say overall is a good stance for an investor right now? Is a more defensive stance for the second half of the year justified? We've just issued our H2 outlook. So if you could just summarize for us what we would recommend to investors right now.
Okay, so it's been really interesting to hear the conversation so far. They very much chime what the multi-asset team talks about. So we called our H2 outlook global rewiring just because so much change is coming in the world. I mean, I think we've touched on it before, but it's worth just repeating. I think there is a fragmentation of world order. The US is driving or wanting to drive significant change in trade, in supply chains. There's a lot of tariff uncertainty out there, and China's trying to balance its external exposures and internal growth drivers. And we're on a multi-year path of decoupling both of US from China, but also other parts of the world. How does it land with Europe? Where do they are? Where are they? So there's a lot of uncertainty on the medium and longer term. But the US at the moment is still holding up. We heard Niamh speak to that. In terms of the companies are still delivering, their earnings are at the moment still decent, albeit from a macro perspective and an earnings perspective there may be a little bit more uncertainty out there. Our key view, putting all that together as a multi-asset team, is we think we're late cycle. We're not calling the recession much aligned with Max's team's view as well. We think in the short term risks are relatively balanced between the upside and the downside. It's easy to talk oneself into a defensive stance, but need to be quite careful. There's a lot of still reasonable stuff going on. So from our side, both offensive bets and defensive bets need to be relatively finely balanced, but the US will be more volatile. You need to be much more diversified than before.
How should an investor approach now the dollar movement? We've seen that the dollar in the macro outlook is one that could at least have more downside from here. The dollar used to be the safe haven for investors. How do people have to approach this dollar view? And is it now justified to hedge the dollar in multi-asset portfolios?
Yeah, like a very topical discussion. So I think for multiple decades, the dollar both was an appreciating currency and a safe haven currency, typically at times of stress, right? So almost your perfect outcome. And more recently, we obviously haven't seen either, but we've actually seen a very different outcome, whether a US dollar-based investor or a euro-based investor or other currencies. So the answer to the question is actually depends very much in terms of, I think, where you're sitting as a portfolio allocator. We tend to see that a lot of investors, they tend to hedge their fixed income exposure. They tend not to hedge their equity exposure. So 20% roughly is the market norm there. And obviously that has outsized impacts, right? Because a plus 5% US dollar return from the equity market is what a US investor is perceived, but a European investor is still in negative territory. So it does really matter. From our side, it's very much what Matt spoke to. From a short to medium term perspective, we are structurally bearish on the US dollar. So we think this trend continues. Max spoke to the US trade policy and what they're trying to drive there is one of the drivers. Valuation is another one of the drivers. It's still relatively expensive on a real exchange rate basis. And investor preferences, it comes with the risks now, it comes with volatility. A lot of people are talking about reducing exposure to US dollar and US assets. So it'll be volatile, but the trend line for the next few years is down. But we're not calling the end to the US dollar. This is not, this is not the end. It's still the most liquid and the most deeply integrated market in the world. It still has the most innovative companies with the best innovation and the best ROE and a very shareholder friendly. There's still a lot of really good things happening and will continue to happen. And certainly now there are not any real credible alternatives there as world reserve currency. So our sense there is, especially if you're a non-dollar denominated investor, yes, the need to hedge goes up. And we've seen, historically, hedging US assets has gone up to like 45%. I think we'll see a rise more in that direction. There's also a lot that can be done on portfolio construction, on diversification, because hedging can obviously be an expensive thing to go. But is it something for non-US dollar investors to think about over the next few years? Absolutely.
And that's where we want to come to as we spoke about a weaker dollar going forward. Lei, I want to come to you once again, or not once again, the first time in this discussion, and talking about the Asian region, because a weaker dollar could be beneficial for Asia as well. However, of course, the trade war, the tariffs might have a negative effect on the Asian region altogether. So in terms of an overall summary, what are your thoughts on the Asian region right now from here with all this macro backdrop considered? Could it come out as a beneficiary of the whole situation right now?
Yeah, thank you very much for the question. So definitely, I mean, this is what the investor has been asking us. If you look at the whole Asia region as a whole, we do have challenges as well as opportunities, right? For Asia, it definitely, I mean, being a big market, I mean, we actually manufacture lots of goods and export to US and Europe. And also we are influenced by China's slowdown and the challenge it faced during this trade war. Overall, we see, I mean, it's an opportunity for the economies in Asia to rebalance. So there's a few drivers in the region. So one is the supply chain shift. So we know, I mean, there is this China and the US decouple process. So it has been over years about, I mean, shifting some, diversify the supply chain away from China and to other building blocks within Asia, ASEAN, and India, for instance. So these regions are definitely benefiting from the supply chain shift. So we are not saying replacing China, but it's a China plus one strategy. And we know because the regions, I mean, the countries nearby, I mean, in the region will benefit the most, right? Because it's a geopolitical location. And on top, so this will provide this drive for the part of the region, while we still see a rebalancing challenge within China itself. So for the second one is the monetary easing and policy driven stimulus inside the region. So it's different from US or Europe. In Asia, I mean, with exception of Japan, most of the major central banks have room to cut interest rate. So in Asia, in fact, the real rate for across the region has been quite low, ranging from like 1% to as high as 3% for the real rate. So previously, Asian central banks, because they worry about FX appreciation, so they have been held back their rate cut. Well, in this year, we know like the crash, I mean, it's definitely free up the hands of the central bank. So we see most of the major central banks here are cutting interest rate, and they have more room to cut. And even their cutting interest rate, the currency has been appreciating across the region. So that is also providing some support to the economies. So that's and also helping the domestic consumption rebalance. In addition to that, I mean, Asia as a region, we also has been influenced by China's easing, the monetary easing situation. So, and also to a certain extent, export the deflation. So the growth prospect for the rest of Asia has been quite promising from these perspectives.
So monetary easing is quite a good argument for Asia. Let's look at China more specifically now. They've waited, of course, until the trade deal with the US is probably fixed at some point. But what are more measures in terms of fiscal and monetary that could come out of China? And because that's obviously the big elephant in the room, so to speak, in Asia and emerging markets altogether. How do you look at the Chinese situation right now? And will they be able to stabilize the housing market and therefore, motivate the consumer going forward?
Yeah, definitely. If you look at the Chinese central bank's action, in fact, they cut interest rate and the triple R the day before they spoke to US, right, in Geneva. So they kind of preemptively doing some monetary easing, get into the trade talks. So our view is, I mean, we still see China central banks and has a room to further monetary easing. If you look at the inflation, right, it's still hang around zero, and while the interest rate is still around 1.4%. In Western standards, it probably should have cut to zero already. I mean, Chinese central bank has been gradually cutting because they also want to see, alongside with triple R cut, they also want to see there's other similars, what's the impact into the economy, as well as see what's the progress of the US and China trade war in case they want to save the bullet for if there's a further shocks in the market. Talking about the property situation, so we see the market has been seeing signs of stabilization, although it's still too early to say. I mean, it's in the process of a rebounding. So if you look at the property crisis for over the past 4 years, I mean, it first kicked off about 2021 when the first developer Evergrande default. So we're already 4 years into the crisis. We know usually property crisis can last for about 5 to 7 years. So we are probably close to the bottoming of the crisis. And we do see Chinese governments has kind of draw a line to prevent big developers being state-owned enterprise, or for the case of Hong Kong, to prevent further shock to the overall market. And we know it takes time to digest the overall, I mean, the unfinished units, etc. But the sentiment-wise, it start to improve and stabilize. And we are in the high yield market. We clearly see, I mean, for the property bonds, it has a rally for the past few months already. Usually, capital markets is ahead of the physical markets bottoming. So we do see there's a signs of improving, not now, but probably in next year's situation.
Now that sounds pretty constructive. Heng-Yan, I want to come to you and ask you, because asset allocation flows have been moving out of China for a long time. It hasn't been a good area for returns in China as well. Now with that longer term stabilization path, what would you argue is a good approach towards Chinese assets? They look cheap, they look like good opportunities altogether. So how should one allocate China in the overall portfolio context?
Yeah, it's a relative attractiveness game, right? And as we heard in the early part of the conversation, there's a lot of question marks have been asked around the US with some potential headwinds, but some real strengths there as well. From our team perspective, and on the emerging markets, as actually say in China specifically, there's been a question mark on investability, on valuation for some time. We do believe from a relative perspective, emerging markets and China do look better. So overall, so within our equity allocation, we have an overweight to China, albeit it has run a reasonable amount in the last few months. So we've tailed that overweight back a little bit. We do believe that the fundamental story and the margins are stronger now than they were a year or two ago. They've had a decent reporting season. They've, I think, surprised the world in the last few months on how strong they've come out and how strong they're developing in the AI space, and the government is looking to support that. And the government here does really matter, right? Where they stimulate, how they support, how they transition the economy away from the reliance on the US towards more domestic consumption, advanced manufacturing, services, etc. Those really matter. So that macro and sentiment story matters. But from our perspective, it's a good story and it has more legs to go. So in most of our portfolios, we do have a preference for emerging markets over developed. Within emerging markets, we like China, and also just to call it out, I think both India and Korea are also, for those portfolios that can play it, attractive places to be at this point. So a view, I guess, very much aligned with Lei earlier.
Niamh, you've just come back from an Asia trip as well, and got a good impression of what's going on there. Maybe you could tell us about what you saw there, how your views have changed, and maybe talk about tech specifically, because I think that's a very important part of the economy that could be relevant going forward.
Hi, Carsten. Yes, I'm just back from a week in Singapore. We have an event every year called Asia Review Week, where we bring together all of our teams of analysts from across the Asian offices, and of course some of us that are based in London as well, and we discussed the key investment controversies for the region and indeed globally. And it's been wonderful, the conversation with Lei and Henk Jan, because these were exactly the controversies that we were talking about. So on China specifically, our session was on China property, China consumer, and China tech. So we care clearly what happens to the economy, but we care most about what it might mean on the equity side for earnings and for the development of the fundamentals of the companies. So I think these remarks will echo what we've already heard. So the concerns are obviously on the property market. So yes, we're hearing that it's stabilized, but I mean, if I was to summarize the conversation and the debate, it was, are we there yet? And it's not crystal clear that we are, because yes, we are many years into it, but there are reasons to still be concerned. And because of that, we're starting to see, or we're continuing to see data that's a little bit more sluggish on the industrial side, but on the more positive side, government is stimulating on the consumer side. There are signs of life on the consumer side in areas like retail. And then we've got tech. So thinking about tech, 2025 has been a year where they're back and they're back strong. So number one producer of STEM graduates, number one filer of patents, number two economy in the world. But this is one area in the world where you can say categorically, they have those platform companies, those amazing quality companies, great margins, great returns, and they're being really clear that they want to have the type of competitive edge and innovative edge as you see in the US leaders. But, and this is really important, they want to be self-reliant. So they don't want to, yes, they will export, but they don't want to be reliant on the US. So you could say China is very quietly and with a much less bombastic approach doing a make China tech great again. and they're succeeding, right? They were already there in EVs, they were already there in clean tech, but on AI now, they are a serious contender. Now, one word of caution. We would be careful to be selective, and this is a theme across many of the markets. We would be careful to be selective. But the Hang Seng is up 18% year to date. It's on 11 times earnings, which is half that of the US market. So China for a long time has been a value trap on the equity side. But if you were to now conclude that that is a market without opportunities, I think that would be extraordinarily short-sighted.
And what is needed to crystallize these things, in the market? It seems that the market is very cautious in its approach towards China. What do you think is needed to make that visible, to make that transparent, to make investors go back again to China and use those low valuations for mid to longer term investment there?
I think two things. It's always about earnings delivery, always about earnings delivery and seeing that potential come through and gains, whether they are in the domestic market or in the nearer export markets. But also, we can't be blind to the fact that you do have geopolitical risk in China. I mean, we saw it with, the threats on tariffs. They've come back down. They're not, as we mentioned before, they've not gone away. So I do think you would need both that earnings delivery and investors. They don't need to be US investors, global investors starting to say, okay, this is investable, and starting to see that risk premium contract.
Now, towards the end, I want to come to some asset allocation conclusions and what trends we see, where we want to be positioned. So, Niamh, maybe starting with you, which thematic trends do you see for the second half of the year, and where would you be positioned with those for clients?
Carsten, I don't think we can talk about thematic themes and trends in 2025 without talking about AI. So our tech team is just back from a trip to Silicon Valley. Again, this is something that we do regularly. They talk to the C-suite, they talk to the technology leaders in the area. And we discussed it as a team afterwards. And one of the remarks was that customer demand on the tech side in the US and more broadly now is about AI and AI. So clearly the demand is there, it's real, and importantly, what we're seeing is customer acceptance. So the B2C was already well entrenched and well understood, but the enterprise adoption is really gathering steam now. And that means productivity gains for companies. They're looking for cost savings, and they're really starting to find the actual enterprise specific solutions now. Now, will that mean that it will manifest immediately? That's not clear. Again, this is an area of huge controversy within our team. We're very conscious that if you look back at the big technological revolutions over time, be it the internet infrastructure plays, be it search, be it the consumer electronics, it's not always the early adopters, the early winners that are the big winners longer term. So you do need to separate the winners from the losers, those that will be that will actually deliver the fundamentals and where it is not already priced in. Because we are investors for the long term, we need to find the opportunity. We don't need to chase what everybody else has already priced in. So we need to separate the winners from the losers, but we do think this is a theme. It's important to be invested in it. We like the picks and shovels, the enablers, the companies that are not necessarily those that have been chased. We think it's really important for investors to be aware of this thing. It may be in certain areas bubble-ish, but you can't ignore it because it can drive a really dramatic productivity change globally. So what we would do, again, be selective, find the companies that are the genuine long-term winners, avoid the hype, and avoid those where you have multiple years of hard-to-attain growth already priced in.
So be selective, be active, and be dynamic. Lei, maybe I kind of come to you because we didn't really talk in detail about the Asia fixed income, but maybe you can summarize for us your call on Asia fixed income and what specific buckets you like most about this asset class.
Yeah, sure. Thank you very much for the question. So we were traveling recently, and then we do see the global investors are looking for safe haven alternative. So this is a very hot topic ever since the April trade talk. So the diversification, we do see Asia offer value to investors, outside of Asia as a region, because Asia is being a more developed part of the emerging market, and it still offers lots of growth. And in particular, like Asia local currency, we do see a lot of demand for that. From Europe investors as well, from US investors as well. As we know, like if you want to diversify your book away from US dollar, US investors have the biggest holding of US dollar asset. So we do see Asia local currency offer value for investors outside the region. And even within the region, we do see investors in north part of Asia want to diversify into south and southeast part of Asia. So definitely diversification and a safe haven alternative is what every investor is looking for. And these days we see there's a shortage of high quality assets. If you just count, how many countries have like AA, AAA rating and still have some meaningful yield? Asia definitely have it, right? So for instance, like Singapore dollar now is a very hot topic at the moment, being a AAA country, and the currency definitely also appreciating and following the trend. So we do see demand in this area. In addition to that, as I mentioned, most of the central banks in Asia are on the cutting interest rate path. So you're not only gaining from the carry as well as from the capital gain and the currency appreciation. Another pocket we do see value is Asia high yield. In fact, Asia high yield US dollar and even the China high yield US dollar asset class has been quietly delivered very strong return, those in 2024 and 2025. It become a carry story, like 2-year duration, low correlation with the global market to a certain extent, because the valuation is still very attractive. So we're talking about 10% for Asia high yield, close to 11% for China high yield US dollar. So year to date, both, for Asia high yield is up about 5%, and China high yield US dollar up about 6 to 7%. And the last year, we're talking about 15% for Asia high yield and 19% for China high yield. So these are mainly just from the carry itself. As I mentioned, it's a quiet area where the valuation is still very attractive. We're talking about 500 to 600 basis point spread, which is 20-year average, while we just came out from some like property crisis, and the rest of Asia actually are benefiting from the supply chain shift, as well as credit rating upgrade for most of the countries and large corporates in the region. Well, for Asia IG, US dollar, we used to be like people were asking us, the spread is tight and it is similar to US IG. However, these days, these bonds also become very attractive. It's even hard to source because of a diversification need, right? Because it's only 600 billion outstanding. Well, if people are looking for non-US IG in US dollar, definitely Asia investment grade bonds serve that purpose. And we have already entered into the fourth year of a negative supply for the past 4 years. As the region itself, I mean, most companies less need to borrow US dollar while the yield is very high, so they are more in the local currency side. So it's an asset class we also see will offer stable return, and for the companies outside the region, like in Europe and US, who are looking for diversification away from the dollar assets, it serves as a safe haven alternative.
Thank you very much, Lei. Before we come to Henk Jan, I want to ask Max one last question, because one issue we didn't talk about was the oil price. And it came up recently with the geopolitical issues once again, and it eased off quite dramatically as well. So what risk do you see, or what path do you see for the oil price in the second half of the year in terms of being a contributor to inflation pressure and maybe supply-demand issues? So where do we see the oil price so to speak, for the second half of the year?
Yeah, absolutely, Carsten. So yeah, to your point, obviously, there was a risk at one point that we would get to a kind of oil up to $100. That would have injected a meaningful third kind of supply side shock into the US and global economy. Again, driving inflation up, between 50 and 100 basis points. Clearly, that kind of downside risk didn't occur. And going forward, I think, given to your point, the supply-side dynamics, supply-demand dynamics, there's a significant supply wave coming in from OPEC. And so actually, I think the likelihood is that prices are likely to fall if geopolitical risk doesn't re-emerge. And of course, that's the kind of million-dollar question. Will a premium still remain to kind of price that risk? Probably. But the overall aggregate index will likely kind of continue tracking down, given supply is now kind of much higher than demand.
Henk Jan, maybe towards the end, one question we also didn't address too much was, we talked about the US, we talked about Asia and China, but Europe is, we didn't talk about it a lot. There's a lot of hope and optimism about fiscal stimulus and things in Europe. So how would that be allocated in an overall portfolio sense? And maybe you could say one or two words about our outlook for Europe from here.
Okay, so Europe has obviously had a good one more recently, done a little bit of the catch-up play based on valuation that Nive also spoke to. And the developments there on fiscal policy more generally, and also specifically in Germany, are ones we're watching very, very carefully, because there's going to be clear winners that come from that, in the defense space and others, etc. Overall, we don't have a strong view on Europe in our portfolios. We have been overweight for early parts of the year. At this point, we're more neutral. We do believe, on a risk-reward perspective, from an equity side, emerging markets is a better place to play offense. Maybe the one thing to watch, maybe that hasn't come up so much in this conversation, is that depending on how aggressive the tariff discussions play out in the US, and how high the tariffs go there, you could well see an export of deflation to Europe and other parts of the world as these goods that used to go to the US find a home elsewhere, right? And that's going to have an impact on inflation, on the ECB, etc. So there's parts of the duration space that can be attractive there. So that's one to really, really watch. So what Trump does will have a very big impact also on inflation and therefore outlook for Europe. So that's one to watch very carefully.
Maybe one last word, because you mentioned diversification at the beginning.
Yeah.
What role do alternative assets play, and which ones do we recommend as a diversification asset?
Yeah, no, it's a good question. So for those investors who have the ability to deal with illiquidity, we're big fans of private assets. It absolutely helps the risk-adjusted return of a portfolio. Depending on whether you want more income in a lower rates world, or diversification from equities, or alternative risk premia, that tells you whether to go more private equity, more private credit, more real assets. Within our private asset allocation, we do like AI. We've got a lot of leaning towards AI, and we work very closely with Nive's team in terms of those types of bets. But do be very, very careful on manager selection there, because dispersion is very, very high. Come back a little bit to what Matt said on the non-equity fixed income parts of alternatives. Gold has a real role to play in portfolios. The higher uncertainty, the higher inflation risks, and the more we get that move that Leigh spoke to of moves out of US dollars, all of those could find their way to gold. So that has a role to play in portfolios. And if you're really worried about geopolitics, that's the other place to go, maybe oil, but maybe gold miners rather than, oil to play, but we don't like the overall balance there. So that's a geopolitical hedge, nothing else. So those are the various alts we think about, but it does, coming back right to the start, it does depend on an investor's willingness to deal with the liquidity in terms of how broad they can go in that alternative space. Final plug, absolute return has a role to play in this kind of environment as well. High quality absolute return strategies have a role to play in a balanced portfolio.
That's all we have time for. Many thanks to our panel for their valuable contributions and to you all for joining today. A recording of this discussion and a summary will be available on your local Fidelity website over the coming days. Additionally, you will also find a broader suite of our H2 Outlook content there. Please do reach out to your local representatives if you have any additional questions. Before we go, just one final request to please fill in the short feedback form, which should pop up once the webinar ends. Your comments and feedback are hugely welcome. Thanks again for watching. Goodbye.